Hello, welcome to the Economic View again. I'm joined as always by Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, good. Evan, we've got off to a flying start in the new financial year. Today, data out on retail sales and trade data. Yesterday, we had the Reserve Bank coming out as usual, first Tuesday of the month. Perhaps we'll start there and then we can talk about the other data that's come out today.
Yep, so let's look at the RBA. RBA is clearly welded to the fence. I'm not telling you anything new. I haven't got anything new to add to that. They were probably slightly more moving towards a slightly more neutral stance. They're still very optimistic about the future, but they do start to point out some headwinds. It's the first time they've really singled out the trade issues with the US. Right. They actually had that as a fairly new part of the statement. Very clearly they understand the impact of that, and they highlighted indirectly the impact on China, and China being our major trading partner. We'll come to that in a minute with the trade balance. I thought it was very interesting also that they have alluded to what's going on in the short-term funding market, and they very clearly tell you that that has already had an effect. They highlight the fact that the Bank of Queensland has moved rates, that AMP moved rates, and they actually sort of don't give an opinion of where they think it will happen. What they're basically saying is that we're also watching these events and how they transpire. So that was the two main key points from the RBA, because they are headwinds to their overall belief.
Yeah, interesting with what the lenders have been doing with their rates for some time anyway, and outside of whatever the RBA isn't doing, the lenders have been adjusting their rates in many cases upwards.
Yeah, and I think from my side of the market, being the funding side, what's also been noted is that this has been happening globally. We know that we've got a US tightening cycle. The interesting difference, though, is that our money market, so your bank bill swap rates, your interbank markets, blah, 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 they haven't tightened back up like other global markets, which I think is also quite interesting. So a lot of these markets happened, LIBOR moved quite quickly, US markets, etc., but they've come back to sort of normal levels where they do spend, for example, 20 basis points above their cash rate, whatever that might be. We haven't done that. We still have a very big gap between what the cash rate is and what our markets on the funding side. And the banks are telling you very clearly that if it continues the way it is, it will make them move rates. And what happened with Bank of Queensland is that, are we seeing a scenario where the one part of their loan book they don't want to touch, which is owner-occupier, because particularly owner-occupier principal and interest players, they also saw changes. And that's the first time we've actually seen this as a blanket movement rather than just being targeted at investors or interest only, which are more easy to absorb it and also that have higher risk.
I'm sure we'll see more of that because lenders will be adjusting up their own occupied books for sure. That also plays into other data that's come out this week. We've seen that housing prices nationally have been dropping in most cities, particularly in Melbourne and Sydney, but Perth also coming back off a bit again. Then we've had dwelling approvals down.
And that I think is very important, is building permits were slightly amazing, particularly if you're in Queensland. The Queensland figure I would take as an outlier. It was staggering. It actually declined 27%. And it was also a big decline in detached housing. It was a 9% decline nationally. And that I think also may filter out. I think that seems a bit of an anomaly, but we are seeing that big supply in apartments has come home to roost, and that is nationally going backwards and has been for several months. But the dwellings of detached houses, particularly down here in Victoria, was quite surprising. But Queensland was the standout, and I think that will probably alleviate because it seems like an outlier. 27% just is too big, so it should come back. But in the main, you are seeing a very gradual decline and only a 3% increase over the year.
Yep. Okay, well, let's move on to, we'll go to trade now. So we've had a surplus for the month of May, which was obviously good news.
It was, and expected. So let's just look at it on a trend basis rather than on a season adjusted. So around $83 billion, which is what you would expect. Again, we are clearly soaking up what's going on in the commodity markets, and that is where the core of this comes through. So what they call their non-rural exports, which interestingly actually also includes sugar, because sugar actually goes into beverages. But you then look at the big three, and that is metals, so that's things like iron ore, copper, etc., coking coal, and then you've got what they call mineral energy. So that is our natural gas. They're the three. They did better this month. If you look at the reasons behind it, you can see oil prices were astounding over the month of June, and the tie between natural gas is almost perfect in pricing. So we got a big kick from that, and there's been an average hold in price in iron ore. Wasn't as good as the May month, but that's okay. It came in basically the same. So we had a 4% increase in exports, a 3% increase in imports. I think this chart on screen, I really want to show you this chart on screen. It's really interesting from the point of view that if you look at that top number, that is China, excluding the SAR and Taiwan, our exports on value, not on total volume, but on value, are outstripping China at the moment because of those three main players. If you did see a decline in oil, if you saw a decline in iron ore, you watch how fast that reverses. So at the moment, we're actually exporting more to China than we import. And the Chinese story therefore becomes very clear, because if we were to see a China slowdown, that export number will come back in value, and that would certainly change that whole scenario around.
Yeah, there's some interesting moves going on in commodity prices right now. You know, quite a number of key commodities have come off, and you know, that's going to be obviously really important for the economy going forward. Let's just move on to retail sales. So we've seen a slight rise in retail sales. Interestingly, again, department stores leading that charge.
Yeah, and actually the first time I've seen it, I think it's about 6 months that every sector not one of them declined. There was one that was dead flat at 0%, but we didn't see a decline. So maybe we are seeing a turnaround in retail sales. It's hard to argue that, I'll be honest with you. And you're right, cafes is leading it, which is quite a volatile item. What was interesting is that the apparel department, which has been the biggest drag outside of department stores, expanded. And that was quite an interesting thing to see. But again, it's the core areas that you look at. And retail sales as a main has been fairly anemic, but 0.4% growth is probably holding trend. We've been downward trending for the last 10 years. And the chart that I'll show you on screen now is the last 10 years of where it's been going. And although we bounced off back in October last year, the year-on-year figure you can see is pretty sluggish. And that, again, is because we know personal finances and family finances are pretty tight, and therefore people's spending is fairly low.
Yeah, and I heard some other data out just on credit card debt. You know, it's still very high, obviously, and so there's that whole interplay between you know, what's going on in retail, credit card debt, and then, you know, in terms of broader lending on housing. So it's all interlinked, really.
It is, and the next thing to look at the credit cards is that there is growing calls to bring in regulation to actually look at the banks pushing people off credit cards with their loans, because of the fact that, you know, your average credit card rate in this country is still 20%, and that is a very, very high amount of leverage to be having put through on what is basically a product of providing everyday purchasing opportunity. So that is the next thing to watch, is whether or not the banks, under what's going on with the Royal Commission and a few other APRA issues, start to force people off their credit cards as well.
All right, Evan, we'll leave it there today. Thanks for joining us on The Economic View.